Welcome to the Brokers Lounge with Eddie and Carlo.
Hi everyone, and welcome back to another episode of the Brokers Lounge. My name's Carlo, and this week I'm not joined by my usual co-host Eddie, but instead we've got Josh Lee, who's a financial advisor and also one of the directors of Link Wealth Group. So welcome, Josh, and thanks for joining us.
Thanks, Carlo. Looking forward to it, mate.
Yeah, so it should be good, and obviously something a little bit different instead of the usual lending side of things and property that we talk about. This is going to be a bit of an insight as to what the financial advisors go through, pick Josh's brain a little bit as well. So I guess probably the first way to start off is a little bit of a background about yourself, Josh, and more importantly, how did you get into financial advice? Because I know your background's a little bit different to the usual that we see from time to time.
Yeah, no, it was a bit of an interesting journey to begin. So I've been in industry now for about 8 years. Didn't initially have my sights set on entering the financial planning industry. So, you know, like a lot of people do, finish high school, don't really know what you want to do. Sort of bounced around. At that point in time in my life, I was actually convinced I was going to be a UFC professional fighter, believe it or not. So that's kind of where I had my sights set in my high school years. And then I actually met my wife. And then life started taking a bit of a change, and then finished high school. I actually started studying criminology, believe it or not.
Oh, wow.
I deferred, I think, within 3 months. And then I was living at home at the time, and mum's like, all right, well, you've got to be earning income if you're not studying. So my brother was actually a concreter. So I figured I did a couple of little trades, and then they didn't really gel with me. And I'm like, look, I can work hard. I don't want to do an apprenticeship. I just want some cash in the bank. So I actually started concreting. I did that for about 2.5 years, but at the same point in time, I then started to look back to get into my studies. And at that stage, I had started some studies with Swinburne. They didn't offer a financial planning degree, though. I knew I wanted to be involved in business. I didn't know what I wanted to do, though. So I looked there, seen there was a Bachelor of Business, majoring in accounting. And I'm like, okay, accounting sounds like a good base. Never had my sights on being an accountant, though. I just want to make that clear. Got through that, was partially through my degree. And then at that point in time in 2017, the barriers to actually get into financial planning were not that great. So you could do a diploma back then. That took me 4 months to do, and then I was ready to be a financial advisor, apparently, at that point in time. So I was concreting for about 2.5 years, working full-time, studying full-time. That was a grind, don't get me wrong, but I knew I wanted to do. Got into the financial planning industry with no experience, and then bounced around a couple of places earlier on, and then I ended up in Link Wealth Group in about 2018, and then, just never looked back since. Career absolutely took off, bought into the business in 2021. And the business at that point in time, I think was maybe 15, 20 staff. And now all up staff-wise, I think we're getting close to 100, which is exciting and scary at the same time. And business is great, life's great. And we've just got plenty more to do as a business as a whole. And that's all entities, not just the advice business, the accounting business, the finance business, the offshore business. There's a lot of fun, a lot of learnings along the way, a lot of mistakes along the way. But I love what I do. I work every day. And that's a bit about me, Carlo.
That's interesting. It's quite a diverse background, isn't it? I think it's probably a bit of a warning to clients out there, like you start off criminology, UFC. So make sure you take Josh's advice. Otherwise. But it's good because and I remember back in the day as well, I did some financial planning units as well, the old DFB 1 through units 1 through to 4, which was really an easy way of getting into financial planning. But I didn't continue on with that sort of thing. Mine was just more from a knowledge point of view. So I'm keen to understand what's your personal philosophy when it comes to helping clients manage their money.
Yeah, it's an interesting one. And the way I was thinking about it was kind of breaking down for any one client. There's we don't deliver cookie cutter advice at Link. There are some firms that do that. But when you think about it, there's all the same areas that every client's going to need help with. So if you look at superannuation, some debt management, some tax minimization, how do they protect their wealth? How do they invest? What's their cash flow doing? So if you break that down into maybe 3 simple categories: wealth creation. So where are we investing? How are we growing wealth? There's a multitude of areas that we could be looking at there for a client. So first and foremost, most clients will usually come to a financial advisor because they want to know how to invest their money. It's pretty simple, but there's a lot more than ultimately goes behind that, because that could be super. We could be looking at other trusts, other businesses, other entities. We could be looking at property. There's a lot that comes under that wealth creation bucket. And then we get into the wealth management will probably be the next piece I'll break down there. And that's more so looking at the movements of money. And that's probably the biggest one I see most people generally don't do right, is they don't know how to control their cash flow, where their money's moving, where it's going between accounts. So that's another big sort of pillar of what we implement as a financial advisor. And then the least exciting part of that would be the wealth protection element of it. And that's where we're looking at insurances. So we build these amazing plans for clients, but then there's also, and that's all exciting, the investment, all of that piece, but then there's also the element of what if something was to go wrong along the journey. That's where the insurances come into play. We might be looking at how we structure assets from a asset protection point of view, succession if someone was to pass away. I work with a lot of business owners personally, and I see a lot of common mistakes that business owners make. Like, for example, I was chatting with a client yesterday, and having, as a business owner, your family home in your name is generally not a great idea. So, yeah, they're the really three main categories that I'll break it down into. And any one client, no matter wherever they're at in life, that's kind of my starting point of how we go about addressing and pulling together a great financial plan.
Excellent. And you touched on business owners. One of the key mistakes they make is having the family home in their names. Is there any or one other financial mistake that people typically don't even realise they're making outside of say a business owner owning their property in their name? Is there anything else that comes across your desk on a daily basis where you sit back and go, another person making similar type mistake?
Yeah, I'd say there's probably two main ones. I'll give you a bonus extra one here, Carlo.
All right.
So the first one will be probably just the structure that they're investing in. And most people normally will default and just invest in their own name. So if they're buying some shares, some ETFs, some managed funds, or they're buying an investment property, most people generally will just default and buy it in their own individual name. So getting the structure right for your investments is the one I see most people always will get wrong, because they go for the default, which is the simple way of doing it in your own name. There's more to it. You might be investing in your spouse's name. It might be worthy of looking at a trust or looking at a company or other structure. That's one I definitely see most people get wrong, and it's hard to unwind when you've done that and you've held an asset for 10 or 15 years and then you want to offload and sell it. A lot of tax involved, whereas if you get that structure right from the get-go, that can pay massive dividends into the future. The other one would just be, and this is nearly everyone I meet, is they don't have a grasp on where their money is, how much they're saving. Most clients I ask, they wouldn't have a clue.
Guilty, Your Honour.
And even the movements of that money, the most common mistake I see there is pay comes in from business, or if you're an employee, comes in, hits one central account, and then all bills, everything moves out of that one account. They don't have separate buckets for all of their expenditure. So what I mean by that is when we work with clients, there'll be an actual cash flow system we'll implement. We'll have the mortgage or the rent is one. Then you'll have your bills or your non-discretionary expenditure, and then separating out that daily expenditure, discretionary expenditure, into one separate account is absolutely critical. And then you have your savings, your investments. That's the one I see nearly everyone really struggle with, is how they're moving their money. And most people generally have pay come in, sits in one account, and then they send everything out from there. And they just ultimately have no transparency on where the money is, how much they're saving. See that all the time.
I feel a little bit better now because I do have separate accounts.
Mate, you're doing well. You're doing well.
Good stuff. What are the key habits that you think financially successful people have? What are the key ones?
Key ones, I think, would be, delayed gratification, probably one of the biggest ones, I think, and that's just really not falling for that shiny object syndrome, like we talk about a lot on the other podcasts that we run, Winner's Playbook. Maybe we give it a plug quickly.
Go for it.
We talk about that a lot, and delayed gratification is probably one of the biggest signals maybe of a successful person. And I see a lot of clients I work with, they're earning amazing dollars, but then their lifestyle keeps up with it, lifestyle creep. So the income keeps going up, it feels great, but then they go from...
It's never enough, is it?
It's never enough, because their lifestyle keeps pace with that, and then they ultimately never feel like they're getting ahead. So delayed gratification, getting a handle on lifestyle creep, I think would be two main big ones, I think, in relation to that.
Yep, okay. And what's the most important thing to get right when you're trying to build wealth? What's the main pieces of advice that you pass on to your clients when it comes to that?
Look, there's so many. You always go to the simple one of don't spend more than you earn.
Yep.
Sounds easier said than done, but it's actually possible to spend more than you earn because there's amazing things called credit cards. So, most people live off their credit card and pay it down. And again, it goes back to the cash flow piece. Most people just don't know really what you're spending, but that's most importantly a big one. But, creating wealth doesn't have to be complex either. Taking a portion of your money, and one big thing I'm always big on, I tell clients, is if the government put up tax rates tomorrow, what would you do? You would pay the tax because you have no choice, and you would figure out your life to be able to live off less. You would do it. So what I always say to clients is then, well, why don't we put a personal tax on ourselves and you take 10, 15 or 20% of whatever money you're earning. I call it paying yourself first. So the money comes in before you do anything else with it. Separate it out to another account or send it to your investment account and then get that money moving for you. It doesn't really need to be much more complicated than that. And you replicate and you do that over a long period of time. Compound interest becomes your best friend. And that's simply how you can ultimately create wealth. So again, I'll put it out to anyone that's listening. And if the government put up tax rates tomorrow, you would suck it up and you would live on and you would live off less. You wouldn't be able to change that. Think about putting a personal tax on yourself, and that's an easy way of starting to start building some wealth moving forward.
Yeah, I guess it's a very similar philosophy to what we use in the lending space, where when we're assessing clients' serviceability and the banks impose a 3% buffer on top in the event that rates do go up, which we have seen happen, obviously. But it's to ensure that today's situation, cast your mind further down the track, if rates do go up by 3%, they're still going to be okay. So I think we do it in the lending space. We probably don't do it as well just from a traditional or an everyday cash flow point of view as well. So
good point.
Definitely good. How do you balance saving, investing, and managing debt? Like people are typically exposed to all different parts of it. Like, what's the best way to manage or balance it all out?
Yeah, I think you got to look there at life stages and really just goals. Yeah. So, as an example, if you're earlier in the journey, you're probably more looking at the saving and the investing as opposed to paying down debt. So, generally, when I work with clients, if they're some in their 20s, mostly in their 30s, 40s, or maybe early 50s. They're heavily in the wealth accumulation phase, and therefore, if you look at the option of do we pay down debt versus do we invest in general terms, if you're going to be investing or you've got a time frame of 8 to 10 years, let's just say, if you look at mortgage interest rate, maybe let's just call it 6% average, but you can get less than that, obviously, these days with the recent interest rate cuts. If you look at the option of, say, paying down debt or investing, if you can get 8 to 10% return on average over an 8 to 10 year period of time, investing, compounding year on year, versus paying down the mortgage at, say, 6%, maybe longer-term average 5%, it's a better option to be investing as opposed to paying down the mortgage. So life stage is what I mean by that, though, is if I'm working with clients in a retirement phase, they've usually done all their wealth accumulation and they don't want to be taking on too much risk. And that's where we might focus more on, say, paying down some of that debt or investing in a more conservative manner because they don't have as long as a time horizon to ultimately invest. But then the other part would just be goals as well. Like I speak with a lot of people and they're like, oh, Josh, should I invest my money? But I also want to buy a home in 2 years' time. I want to buy my first home in a year's time. That's a clear example. Whereas if you're in your 20s and 30s, although you want to be investing and getting that good growth, if you're only going to be investing for a short period of time because you need that money to achieve whatever your goals may be, it could be a holiday, it could be renovating your home, whatever it may be, that could be a clear example where it's better to save than invest. And that's where we might just save some money, put in a high interest saver or whatever it may be, because that's what's right to ultimately meet that goal. So normally there's a combination of all of those things in any plan I do with the client. So they're going to be saving some money always. If they've got a mortgage, probably going to stash that in the offset. There might be an element of debt reduction there as well if we're building up funds in the offset. But generally, most wealth accumulators, I don't have them paying down hard on their debt. They're usually actually going the other way and getting into more debt because they're going to be looking at scaling and building out their asset base, such as buying an investment property as well. So yeah, life stages, goals, but usually there's all of those three pillars are being addressed in some way, shape or form for all clients. Yeah, and I think touching on the life stages, I think one of the important things that I've seen, I guess, over my journey, because I've been around a lot longer than you, Josh, yes.
is people in the past tend to go to a financial advisor as they're getting towards the end of their careers, like setting themselves up for retirement.
Yep.
Nowadays, it's there's no time to start. It's like get started as soon as you can and bring someone along on that journey with you, because it's important, because every different life stage has a different type of advice that you need to have. So rather than wait to the very end and go, that oh shit moment's like, okay, now I'm a bit stuck. How do you can't unwind what you've had in the past. So it's important to get started early on the piece.
Yeah, and you're talking like an advisor there, Carlo. So maybe there's another career path for you, mate.
I'm too late to change careers.
But it's so true. And I tell clients all the time, like when they come through to me in their 30s and 40s, like you've got such a long runway to go here. Yeah. Even if we make some mistakes along the way or something happens in your career or life happens, you can still get up and make it happen. Whereas if you're in your late 50s or we're in our early 60s, like I can't help you really. We can still scale some wealth, but you should have done all your risk taking at that point in time. The runway there is not as long, and therefore it's time is definitely a factor. Yeah,
very good. I'm going to shift tact a little bit. I want to talk a little bit more around today's landscape. It's an ever evolving, ever changing landscape. How do you see people are adapting to the higher interest rates that we've got at the moment, and the economic uncertainty for 2025? Probably more on I won't just say global scale, because it's probably a little bit here in Australia as well. I know we've just had the federal election, so hopefully that's adding a little bit more certainty the way people see things. But globally, there's still a lot of uncertainty.
Yeah, well, I think there's just always going to be uncertainty around it. And I always just speak to my clients around all of the macro events, where interest rates are going, what Trump is doing, who's going to win the election. Like all of those things are out of your control 100%. And therefore, even for me, look, as an advisor, I have to be across those things, and sort of messes with your mind a little bit when you're seeing all the ups and downs and all the time in the market. But I don't really sweat on a lot of those macro factors, because I can't ultimately control. And the expectations are, as interest rates are going to come off a little bit here in Australia, but we know that that's hopefully what's going to occur. But we also know, if we look back historically and we go back to the COVID time when the Reserve Bank came out and said, I think it was a couple of years interest rates weren't going to move for, and everyone went out and borrowed, and then up she went a few months later, and the highest amount of interest rate rises we've ever seen. So I just, I sort of caution clients around worrying about all of the macro, just really focusing on the things that you ultimately can control, which is, what are you earning? What are you doing with your money? Where's your money going? At this point in time, talking to what are people doing at this stage? For sure, cutting back on some expenditure. I am seeing that, but to the same degree, I'm still seeing everyone going on holidays, buying new cars. So I don't necessarily know if that's really changed a great deal. And then I think now with interest rates, the expectations that they're starting to come down a little bit here. I don't know, there's a bit more optimism in the markets, and people are back spending again. So even as interest rates went up, most people, I think, maintained their level of lifestyle, but naturally drew down on their savings through that period of time. So it's an interesting dynamic, that.
Yeah, I think coming out of COVID was probably the telling factor in terms of people wanting to make sure they still take or have those opportunities in life to go on the holidays and whatnot. So, people was like, we'll lock down for a couple of years, literally. So coming out of that, people were like, well, we're not going to sit back and wait, because we don't know what's around the corner as well. So,
well, that's a good point, though. The lifestyle factor is a big one. And that's, for every client that I work with as well, is that there's that trade-off of, do we invest or do we put more towards the lifestyle? And there's no magic formula for that. You just got to figure out what is right for you, accept there's trade-offs there, and make your choice.
Yeah. Okay. I'm going to have a bit of a quick fire round, I call it, where I'm just going to just throw some very quick questions to you.
Yep.
What's the most underrated financial tool?
The most underrated financial tool. Most underrated financial tool. I would say, like you said, look, there's a multitude there, but the compound interest calculator, or all the calculators on moneysmart.gov, like they're all free. There's a bunch of great tools on there that are all free. One of them is a compound interest calculator. So if you want to invest $10 a week or $100 a week, what would that look like in 10, 20, 30 years' time? That's a great one. The budget planner's on there as well. I usually send that to clients to get them to fill out their budget planner. I personally use it as well when I'm just looking at my expenditure. There's a great range of free tools on there that you really can't go wrong.
Excellent. And one money habit you absolutely swear by?
One money habit I absolutely swear by. Oof, that's an interesting one. One money habit I absolutely swear by. I think it would be as simple as always taking a portion of whatever you earn, no matter what, and investing it. I've always done that. I was actually the other day I've trimmed down on some of the first ever shares I bought. Everyone starts their journey buying direct shares, and I was no different. I'm actually going to do a video on social media about it because I looked at my first ever share I bought was A2 Milk back in 2016.
Oh, wow.
So about 8 years ago, it actually did quite well. But ever since then, I've always been investing no matter what, as my pay is changing, moving around, buying houses, whatever it may be. Sometimes I'm investing a lot of money. Sometimes I'm pulling that back. Like I bought a nice home in the last 12 months. I've had to sort of scale back how much I am investing, but I've always kept those contributions going to the investment accounts no matter what, and that will be definitely one habit I swear by.
Excellent. And I think I know the answer to the next one, but real estate or shares?
Ooh, yeah. God, I love both. It's I don't want to be a fence sitter there. Look, the major differentiating factor there is the leverage component of real estate, and that's why I personally love real estate. Got multiple properties, but then you can't also discount the factor with shares and with real estate. With both, there's a lot of risk, but particularly with real estate, lack of diversification, issues with tenants, expenses. Like I'm going through some issues as well in mine at the moment up in Queensland. The floods hit, new aircon goes, there's mold smell in the house, showers all need to be resealed. It's not pretty. But the leverage factor there is the real winner. I think I might give you an answer here in a second, but shares you just can't go wrong with because you're buying the best companies around the world. You can invest $1,000 and you could own 1,000 companies in it. So the diversification factor is huge for shares. But if you look at historically, longer term, they're going to get pretty similar returns if you look on historical averages. So let's just use the 6% growth rate for property in Australia longer term. You add on 3 or 4% income, depending on where you are. That gives you sort of like a 9-10% return. The Australian share market's done pretty much the same as well. So if you look at them side by side on that assumption, it's like, well, they're both going to do the same over the longer term. But the difference is with property, you can leverage a lot harder into it. So if you've got $100,000, you could buy a $500,000 property. Whereas with shares, you can leverage into shares. It's a bit more complex, but really it's
a bit more risky too.
Risky margin loans. You go $100,000, you've got $100,000 in shares. So look, I don't want to be a fence sitter, so I would give the slight edge to property just because of the leverage, but I equally love shares. And what I do with my clients, what I do with myself, both. So I've gone back to being a fence sitter there.
Very good. Just I guess in terms of some final takeaways before we close out, if listeners to this podcast only remember one thing from today, what should it be?
I would say don't be afraid to get help and, just surround yourself with a good team. And I always talk about the concept of the dream team. It's not something I've made up, but I always talk to my clients around, you want your good advisor, you want your great mortgage broker, you want a great accountant on your team, and then there might be some other people that might be there a bit more transactionary, a lawyer, a buyer's agent. But having your dream team and those right professionals in the right place, there's really nothing that you cannot accomplish. And that's something I work personally with a lot of my clients around is making sure they've got the right people on the right team, because sometimes they don't know if an accountant's doing the right job. They don't know if their mortgage broker's doing the right job. And we've personally worked on some scenarios where I've actually picked up something's wrong here from the broker and then I've thrown it to you and then you've done your piece as well. So I think getting your dream team right, there's nothing you can't conquer in the world.
Agree. Love it. Absolutely love it. More importantly, where can people find you, or how do they work with you? Where can they get your details?
Yeah, Carlo. Well, we've got the Winners Playbook, of course. Yep. So the podcast on the advice side of things, and we'll probably have to get you over there at some point in time as well, because your co-host Eddie has joined the Winners Playbook before. But yeah, we do a lot of social media in the business. You can find us TikTok, LinkedIn, Instagram, virtually everywhere at this point in time. And if anyone ever wants to chat, they just jump on the website or go through to one of our booking links, and they can come through, not necessarily just me, but any of the advisors on the advice side of things, and have an initial call and ultimately see if we can help them out, or if not, we can at least point them in the right direction of who they may need, because it might actually just be a mortgage broker, or it might just be an accountant.
Excellent. Love it. Thank you, Josh. Very insightful. You've heard it from one of the best. So, great advice and great tips as well along the way. So thank you again for joining us today. Thanks everyone for listening again. Feel free to subscribe to our podcast going forward. Leave us some comments as well. We'd love to hear your views as to potentially any other guests that you want to hear from as well. But until next time, we'll catch you later. Take care, everyone.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances.